Is now the time for traders and investors to pivot and rotate back into growth stocks and high-risk sectors? Well, that is probably what our next guest is doing. Chris Vermeulen is back. He is the Chief Market Strategist at thetechnicaltraders.com. Welcome back, Chris. You've got some new trades for us. I'm excited to talk about them. First, let's go over the larger picture of the signals you're looking at. You told me offline you've got some new buy signals that you've been alerted to, and you told me that you're going back into growth stocks. Why?
Yeah, sure. Well, we've seen a pretty good correction this year in equities, and growth stocks really topped out, way over a year ago in February, March of 2021. So growth stocks have been falling for a long time. They've been in a bear market, but they're starting to get fairly oversold. And we're at a point here where they're at a point that they're so oversold that they're starting to put in a bottoming pattern. We're starting to see growth stocks perform, build basing patterns and start to rally here. So I'm really starting to like this momentum. I mean, you and I were talking off camera. If we were kind of to look at the kind of market chart here of where we are in terms of the market sentiment and where we have and been and where we're going, the 2020, early 2021, we hit this euphoric phase and with growth stocks, and they have topped out, and growth stocks are kind of already, very oversold. They've gone through this full bear market phase where you blow off, you have a complacency rally. And a perfect example of that is actually, if we take a look at the ARK-K ETF and you just look at this ETF, this is like the signature pattern, a stage one, big rally, a blow off phase in early 2021. It stalled out and then it went into the bear market phase. So that's kind of where growth stocks are, and they're back down at a basing formation. But when we look at this complacency rally area here from the broad stock market, I think we are just about to start this complacency rally in stocks. And I think this is a great opportunity for potential trades that could last several weeks, several months, and growth stocks perform very well during this. Now, it might be the last chance to take advantage of them before we roll over. And I think we're going to enter a much bigger bear market. I think we just scratched the surface of the damage that could be done. But that's kind of the high level of where we are kind of in terms of the market. We're seeing growth stocks come back to life and starting to outperform defensive assets. And that is a sign that big money's starting to rotate back in, and there could be something with momentum behind it.
Chris, isn't this a very risky trade? If you mistime this complacency rally, you're basically buying at a high, and you're just in for a ride down. It's basically what that chart shows. How are you? So how are you positioning yourself, and how are you? Are you basically how are you timing this?
Right. So I'm it's kind of confusing. I get it, because I'm mixing up kind of long-term trends with short-term trends. So from the stock market standpoint right now, it feels like we are right here on this chart, and we're about to start a new rally to the upside. And when the stock market goes up, almost all stocks go up. And if the stock market's going up, you generally want to be in the stocks that move up the most. And those happen to be growth stocks. So we are in that phase right now where growth stocks should come back to life for a bounce and a rally here that lasts a few months. And then I think we'll see everything roll over, and it'll be a whole new game changer going down here. So the reality is the tide is about to go up, and the tide lifts all boats. So you want to get positioned into the sectors and the stocks that are going to rise the most and have the most upside potential. And growth stocks are showing signs that they want to lead, they want to take off again. And so this is an opportunity. It's not a buy and hold opportunity by any means. This is a trade. It might last a few weeks. It might last a few months, but there's a lot of upside potential. So that's why I'm saying, the broad market's going to bounce. We want to move into the best sectors or the best assets here while it's going higher.
What's your upside target? How much in gains are you looking to take in before you exit?
Yeah, it depends on the play. So for example, one of the trades that we're in right now is QLD. And so we've already pulled some money off at a 6% gain last week. And I think there's potential for about a 15% rally from where we got in.
Right.
So there's some pretty good upside. After that, it's going to be a 20% upside target. And QLD is the NASDAQ 100 ETF. It's the 2 times leverage. So we're looking for roughly a 20% move We got long last Wednesday at the opening bell. So we're looking for, which would be a 10% move in the stock index. So it's a pretty substantial move. There's a lot of opportunity here. It might only last, a few weeks, but it could work itself out over several months and kind of drift itself higher. But there's a lot of opportunity that we want to take advantage of in this type of bounce.
Okay, I'm going to get into a few, not all, but a few of your specific trades in just a minute. But first, I'm curious to understand your exit strategy. Are you looking to just cap out on a certain percentage of gains and then just take profits and leave it? Or are you looking for maybe signals to reverse that would indicate to you growth stocks are no longer going to do well, or you're just going to wait it out? How are you? What's your exit strategy?
Yeah, well, we do a kind of a blended approach. So we look at it from a high level. This is a weekly chart of the SP 500. This goes back to 2016. If we were to zoom into the current time frame now, you can see our long-term investing signals are red. We are technically in a long-term downtrend. So this complacency rally is a counter trend rally. The long-term trend, I think, is still going lower, but I think we could see this market continue to rally up for several weeks, potentially a few months. And because this is red and the long-term trend is against buying the stock market right now, we have to be extra conservative or aggressive on taking our profits. For example, if we look at the NASDAQ here, this is this year's trading chart of the NASDAQ. We've got, went into a sell signal here, and then we had a buy signal back in March. The market moved a nice 5%, hit a target, rolled over. We had a break even stop, and then the market collapsed and sold off. And you can see here's our next trigger that we had last week. We got in, we caught a 6% move in QLD on the quick pop. Now we're waiting to see if we're going to get the follow through. And if we get the follow through, we're going to see a very significant rally up into this 15-20% mark going forward. And if that's the case, some of these growth sectors are really going to pop and scream to the upside. So it's right at the beginning of a trend here. We need to see if we're going to get follow through. The nice thing is our trades, we put on 7 new trades, and we've already locked in gains on 4 of them. We've closed 2 of them out. And so we're being very tight with our targets and our stops, because this market could roll over and collapse very quickly. And the one thing we don't do is hold on to losing trades. We only focus on stuff moving up. If it shows that it's running out of momentum or has lost momentum, we take profits and we exit. So we're pretty aggressive that way. And that's our whole core is, we win by not losing.
Chris, I want to dig into your buy signals a little bit more. Can you explain just briefly the technical indicators that compose or are that help build these buy signals?
Sure. Yeah. So one of the most basic ones is simply price needs to close above the 50-day moving average. It is as basic as that can get for that one signal. For example, as you can see here, this blue line is our 50-day moving average, and the price closed above it. So the next day at the opening bell, we get long and we move in. Now that's not, there's a lot more layers to this. There's cycles, there's sentiment. We've got momentum has to be on our favor on a 30-minute chart. We're comparing different asset classes, like how is gold performing to bonds? How is the stock market performing to bonds? And we're trying to find all these different relationships that are telling us, is big money moving into defensive sectors or back into growth sectors? And so when we have a certain amount of things line up and price is starting to trend higher and it closes above the 50-day, that's when we're like, okay, here we go. This should be a fresh new setup. And hopefully it's got legs and we can get into those. So there's quite a bit behind the scenes, but from a very basic level, you can see here, if the technicals, if the momentum and the sentiment align, when we close above the 50-day, we do get a signal. But it's not always the case that you just are above the 50-day and you buy. A lot of times it'll go above the 50-day, but we do not have a buy signal and it can roll over. So
in theory, then the sell signal would just be the reverse?
Yeah, it would be pretty much the exact reverse. So everything is not aligned or price corrects deep enough that it either triggers a protective stop or it hits a break-even stop. So our positions are kind of dynamically changing. So we have an initial hard stop when we get into a trade, which is this line here. As price moves up and hits its first target, our stop goes to our entry price very quickly. So if it just rolls over and dies, we get the rest of the position out at break even, and then the market can go do whatever it wants to do. And so that's the scenario that we've got unfolding over here, and we're going to let this continue to mature and move forward. So there's a few other things that we bring into this, like if I was to kind of bring up this hierarchy of positions. So, for example, this is the SPY, and then we got bonds, and we got the US dollar index, the inverse US dollar index, and then we got bill, which is the 1 to 3 year treasury notes. And this, from a really quick high level, this is telling us the volatility from the max high to the max low over the past 20 days. So the SP 500 had been moving 14%, 14.28% over the past 20 days. Bonds were just about half that. And then the US dollar moved about half of what bonds did. And then if you just go into like more or less a savings account and earn a little bit of interest, it barely moves. So what happens is when we get a bear signal, a sell signal in the stock market, we look to move to bonds, which have a very low correlation to the stock market in most cases. And so we're moving away from volatility. If it doesn't have a signal, then we look to move to the next asset class, which is the US dollar. If it's bullish, then we want to move into that. And you can see it's much lower volatility. And then, of course, if there's no signal in either the rising dollar or the falling dollar, then we would move to a cash position and just earn interest. And to kind of give you a visual of how this looks, here's the COVID crash. This is our hierarchy. This is SPY, TLT, UUP, UDN, and bill. And so we'll be long equities. When we got this sell signal in the stock market, we look down for the next asset class, which is TLT. It had to meet all of our requirements for the trigger. Just like I mentioned to you before, we have to have the technicals line up, sentiment needs to line up. We moved in and we caught a beautiful, almost 20% move in TLT. And then we had our trailing stop. This is a huge bar. This is like a 5 or 8% moving day. So we had a trailing stop got triggered during that day. And then we moved to cash, and you just earn interest sitting in the bank in your brokerage account. Until we get a new buy signal in the stock market. And then we moved back into stocks at almost a 13% discount. And then this rode up to go to new all-time highs. So we have a couple ways of playing this market. Either we move to growth sectors, or we can navigate the very defensive, conservative way through bonds, currencies, and then cash, versus like the buy and hold strategy where you draw down 32% and then you ride it back up. And this example is perfect. You make money, you make more money, you make a little bit of interest, and then you get to buy the stocks back at a 13% discount and continue on. So this is kind of the way, which I call the CGS, our conservative growth strategy. This is how we can avoid getting into really volatile stuff. We actually go the opposite direction of growth sectors. We actually start moving into defensive plays, and it creates a really consistent strategy. And so we blend these two strategies together, growth stocks like sectors, and this more conservative way. And it really, creates a really clear picture as to where to move your assets. And, this is this year, the stock market, then it was the US dollar. Then we went back into the stock market for a little gain. Then we went back, the US dollar rallies while the stock market's down like 14%. So it allows us to just flip between asset classes. And the question is, do you want to do growth stocks and go the aggressive way, which can have bigger returns at times, or do you want to move to something like this, which is like, let's actually step away from the volatility and take the conservative approach, which more, investors, long-term investors prefer this way. This is actually my preferred way of trading because it's the most stable, lowest volatility, and it actually is much more consistent long-term than trying to trade growth stocks, because growth stocks are only really good during very short windows of time. Like they last 3, 6, 8 months, and then growth stocks are a real crapshoot. While the stock market continues to have beautiful trends, so do bonds and currencies.
Okay. You're talking about growth stocks now, but what about the broad market, SPX? Let's take a look at the SPDR.
Yeah.
SP 500. Similar play or no? Are you staying away from the broad markets? Keep in mind, though, the S&P 500 is composed of a lot of tech stocks, so it's a semi-tech play at this point.
It is, but I mean, when we trade the NASDAQ and we trade the SP 500, we trade both of them like a 50-50 portion of yes. the, index allocation. And believe it or not, with the same strategy, they produce very different trades because they move on a percentage wise different, different swings. So one of them will be hitting targets, the other one won't. NASDAQ could get stopped out sooner, but the SP 500 could keep on trucking higher. So believe it or not, I look at the QQQ as growth stocks. I look at the SP 500 still as blue chips. Just because it's got a lot of tech, I don't see it as a growth sector. The NASDAQ definitely performance wise still moves and trades differently, even though they look similar and they all move up and down together. Over the long run, they still produce very different returns. So I love the SP 500. It is kind of my baby. If I know what the SP 500 is doing, I can pretty much navigate the rest of the market, because to me, everything is linked in a way to the SP 500.
Okay, Chris, well, could you give us one of these trades?
Sure. Yeah, let's take a look. Actually, we'll go over to go to TAN. TAN is a beautiful looking chart that's got a lot of upside potential. If we take a look at TAN here, we've got this beautiful W formation, which is known as a double bottom. It creates this very significant resistance level across this chart. And when we look on the more hard right edge here, we also have this nice bull flag pattern forming here, and price is kind of just coiling sideways, building up energy. That if this growth, this next wave here, if we get follow through this week, the Fed is going to be coming out. He's going to shake things up. But if we do get the pop in growth stocks and we see the follow through, I think we could see TAN really take off to the upside in terms of upside potential. We can quickly gauge where that is using Fibonacci extension. And that brings us up to about $89. And from the current price right now, we're just pull that up. That is about a 23% rally for TAN. So I really like this ETF. It's still kind of in limbo sitting here, but we're long and we're waiting to see if we're going to get that big breakout. It's got one of the strongest patterns here for a big move. And that's just the first leg. The next leg would bring us somewhere up, right up to this 100 mark, which is a very significant move to the upside. So, 38% move. So that is one sector that's primed and ready to go. And the other one was ARK. We got into ARK, but we actually already took profits and we moved out of the ARK ETF. I don't have the intraday chart here, but I could actually pull it up, because this stock market is moving so fast. It's pretty wild. So we got into ARK at the open. We had a buy signal. We got in, we actually hit our target, the first day, and then our stop moved to break even. And then it sold off 2 days later, hit our trailing stop. And now it's struggling. And we've seen this happen with a bunch of growth sectors where they had a quick pop and then they fizzled out and rolled over and died. And this is why we need to be really defensive with our positions, because this market is very chattery. It could take off or it could crash. And so when we hit these targets, these fairly tight targets, we move our stops, we get very defensive because they can roll over in a heartbeat. So it's about just grabbing quick profits. If it's going to follow through and keep running, we hold on to a portion of it. But if it shows any weakness and wants to come back to where we got in, we're just getting back out, because we are technically, in a bear market, and stocks are more likely to continue down over the long run.
Okay, let's hope Kathy Wood doesn't rebalance and do anything outside the ordinary until you sell. Let's talk about gold finally, Chris. Now we're almost at the key psychological resistance level of $1,700 today. As we're speaking Monday morning, we're at 1726, and it's just it's been a steady downtrend. It's been a steady, I wouldn't say roller coaster ride. I would say one of those carts going down the hill. Off the side of the mountain, you see these scenic things in Switzerland, and if you go on Instagram, you'll see these people going on these carts down the side of the hill. That's kind of like what gold's been doing. It's not hasn't been a very dramatic move, but it's just been steadily declining. Is this going to end anytime soon, or what are the charts telling you?
Yeah, you look at the chart. I mean, we've got this blue line across here. This is a very significant support level. Going back in time, I mean, major highs here turned into major lows. double bottom, another spike bottom, and we're back at this level. So we're at really strong support. The only thing that gives me a little bit of concern is technically when you hit a support level for the first time, you usually get a knee-jerk reaction bounce, a reaction high. So, and that's what we had. And that was also happened to be right off the ECB was doing their rate change. It created a pop in price. So we need to see if we're going to get some traction. But for, when you look at it, technically, this is support. From a long-term investor standpoint, this is a level that, adding to your stack is an opportunity. We're not out of the woods by any means for gold. We need to see it start to make a series of higher highs and higher lows over the next several weeks. If it could just work itself up or build a base here, a nice clean base of sideways price action, when it pops above that base, that could be the start of a new uptrend. Mm-hmm. So I definitely think we're going to see a bounce in gold and miners. And if we are going into a true complacency rally for the stock market, gold miners should perform really well. They tend to become a market leader. And right now they're at the bottom of our ban hot list, our best asset now list. They're one of the worst performing sectors, but they could come back to life very quickly and become a leader for, 2 or 3 months. So we are, right at this amazing tipping point where growth stocks and I think precious metals and miners could take off. The stock market will move higher. And it's going to be a great opportunity for, I think, a couple of months here.
All right, Chris, well, I appreciate your thoughts. And before I let you go, I know you've only given us 1 or 2 trades today. The viewers can view a lot more and learn a lot more from you if they subscribe to your service, right? Where can they learn more about your trades?
Sure, yeah. If they visit thetechnicaltraders.com, every morning I do a video just like what you and I are doing here. I run through all the charts and I share what's going on, any trades I'm putting on. And of course, we manage all these positions together with trade alerts. So it's pretty straightforward, exciting service, highly educational. If you want to learn and more or less earn at the same time, that's what I provide.
Great. Well, we'll have you back on again to talk about more of your buy signals and equally importantly, sell signals, right? You can't be getting into a trade without knowing exactly how to get out. So we'll have you back on for sure.
Yeah, sounds great.
All right, Chris, thank you so much today. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more and subscribe to our YouTube channel.